Welcome back to Advanced AutoTrades, everyone. I'm excited for today's episode because we're diving into a topic that I know can be a game changer, but also a potential minefield, especially for newer traders.
Yeah.
We're talking about auto trading.
Okay.
And let's be real, the idea of hands-free trading, of a system making those split-second decisions is super alluring.
It absolutely is. The promise of consistent profits without being chained to your screen all day is definitely a dream for many.
But like any powerful tool, auto trading needs to be handled with care and understanding.
Right.
We've seen it firsthand.
Yeah.
Traders, particularly those just starting out, who jump into auto trading head first, expecting it to be this magical money-making machine.
Right.
And sadly, they often end up making some pretty costly mistakes.
Exactly. One of the biggest pitfalls is overconfidence.
Okay.
And I'll share a real-world example to illustrate just how dangerous this can be.
Okay.
I once knew a trader who was so convinced of his system's infallibility that he put 90% of his account on margin. He was aiming for those quick 5% weekly gains.
Yeah.
The kind of returns that make headlines.
Right.
But here's the catch.
Yeah.
His system didn't account for a sudden market shift.
Oh.
A trade didn't close when it should have, and overnight he lost almost everything.
Ouch. That's a brutal lesson to learn. And it really highlights why blindly trusting any system, no matter how sophisticated it seems, is a recipe for disaster.
It is.
So what are some concrete steps we can take to avoid falling into that overconfidence trap?
Well, first off, let's talk about naked options.
Okay.
These are options contracts traded without owning the underlying asset.
Right.
And they carry unlimited risk.
Yeah.
Definitely not something we want to mess with, especially when starting out.
No.
Instead, always opt for strategies that limit your risk,
Okay.
such as credit spreads.
Right.
These involve simultaneously buying and selling options, effectively creating a safety net that caps your potential losses.
Okay, so limiting risk through strategies like credit spreads. Got it.
Yeah.
But how much should we be risking per trade?
A good rule of thumb is to risk no more than 1% to 5% of your total account on any single trade. Think of it as setting a budget for each trade. Now, smaller accounts might be able to take on a bit more risk, but it's crucial to be honest with yourself about your risk tolerance.
So it's kind of like setting up guardrails, right?
Yeah.
You're defining your boundaries to protect yourself from those potential losses.
Yeah.
But even with those guardrails in place, isn't there still a chance that things could go wrong?
Sure. That's where being proactive comes in. Set up alerts for any anomalies that might pop up.
Oh.
Things like missed trades. And I can't emphasize this enough, weekend reviews are a must.
Weekend reviews?
Yeah.
You mean actually taking time to look at what the system did, even though it's supposed to be automated?
Yes, absolutely. It's about understanding the why behind the trades, ensuring your system is still aligned with your goals, and spotting any potential issues early on. It's about staying engaged even in an automated environment.
That makes a lot of sense. You're not just blindly handing over the reins, you're actively participating in the process.
Sometimes simplicity is key. In fact, many professional traders stick to those straightforward option strategies we talked about earlier, credit spreads,
Okay.
and they focus on liquid instruments like SPY and SPX.
Well, I'm sure some of our listeners might not be familiar with those. Could you break those down for us a bit?
Of course, SPY and SPX are exchange-traded funds, ETFs, that track the S&P 500 index. They're incredibly popular among options traders because they offer high liquidity,
Okay.
meaning you can easily buy and sell contracts without significant price slippage.
Okay.
And for those with larger accounts, that liquidity is especially crucial.
So for these pros, it's about sticking to what works, what they understand, and minimizing unnecessary complexity. But what about the allure of those complex systems, the ones that promise outsized returns?
It's easy to get seduced by those claims, but I'd advise extreme caution. Be especially wary of services that lack transparency.
Okay.
If a service doesn't offer a free trial or even a monthly subscription, that's a major red flag.
So it's like a test drive.
Exactly.
You wouldn't buy a car without taking it for a spin first, right? You want to see how it handles, make sure it's the right fit for you.
Exactly. And just like with a test drive, you're not just checking a box. You're gathering data, building confidence, and making sure the system aligns with your goals and risk tolerance.
This brings up another point that I think trips up a lot of traders.
Yeah.
Jumping into auto trading without properly testing the system.
Absolutely. We always recommend trading a new strategy with just one contract for at least 3 months. This allows you to gather real-world data, see how the system performs in different market conditions, and adjust your allocation accordingly.
So it's about proving the system's worth before putting serious capital at risk. Okay, so we've talked about the importance of limiting risk and avoiding overconfidence, but let's really unpack this whole risk management thing. I have to admit, this was something I struggled with when I first started auto trading. I kind of thought, hey, this system's supposed to handle it all right, but I quickly realized that wasn't the case.
You hit the nail on the head. Risk management is like the bedrock of successful trading, and it's especially important in auto trading. Let's break it down into manageable pieces. First and foremost, limiting your risk per trade is paramount. A good rule of thumb, and we mentioned this before, is to never risk more than 1% to 5% of your total account on any single trade. This helps prevent one bad trade from wiping you out.
That makes sense, especially for those of us who aren't trading with millions of dollars. But I imagine for larger accounts, that percentage might be even smaller, right?
Exactly. Think of it this way. The larger your account, the more you need to protect. So those with significant capital might risk even less. It's all about preserving capital and ensuring you can stay in the game for the long haul.
So it's about thinking long-term, not chasing those quick wins that could potentially blow up your account.
Precisely. And it's not just about setting that initial risk limit. It's about sticking to it even when you're tempted to increase your position size after a few wins. Greed can be a powerful emotion, and it often leads to overconfidence and impulsive decisions.
Oh, I've been there. It's so easy to get caught up in the excitement and think, this time it's different. This time I can risk more. But that's often when things go wrong.
Right. Now, another crucial aspect of risk management is establishing a clear risk-reward ratio.
Okay, risk-reward ratio. We hear this term a lot, but can you explain it for those who might not be familiar?
Sure. In simple terms, it's the potential profit you stand to gain on a trade compared to the amount you're willing to risk. Ideally, you want a reward that's at least twice the potential risk. So for every dollar you risk, you're aiming to make $2.
So if I'm risking $100, I'd want to aim for a profit of $200.
Exactly. That's a 2.1 risk-reward ratio. Of course, not every trade will hit that target, but over time, maintaining a favorable risk-reward ratio can significantly improve your overall profitability.
That makes sense.
Yeah.
But what if a strategy has a really high win rate? Couldn't we afford to have a lower risk-reward ratio in those cases?
That's a great question. Yes, if a strategy consistently wins a high percentage of trades, even a 1.1 risk-reward ratio can be profitable in the long run. But it's essential to verify that win rate with real-time data. Don't just take someone's word for it.
So it's about balancing that risk-reward ratio with the historical performance of the strategy. That makes a lot of sense.
It's all about finding that balance between automation and oversight, leveraging the power of technology, but also staying engaged and informed.
So what does that look like in practice? What should we be monitoring on a regular basis?
Well, first off, trade execution. Are your trades being filled accurately? Are there any missed trades or incorrect position sizes?
Okay, so making sure the system's actually doing what it's supposed to do.
Exactly. And then there's your broker. Are they executing trades promptly? Are they providing transparent reporting? Do they have a reliable track record?
Right, because even the best auto trading system is useless if your broker's dropping the ball.
Absolutely. And then, of course, you want to review your overall results regularly. Are you still on track to meet your goals? Does your strategy need any adjustments?
So it's like a continuous feedback loop, right? Monitoring, adjusting, and making sure the system's still aligned with your objectives.
Precisely. Now, speaking of potential pitfalls, we can't overlook the ever-present risk of scams. The auto trading space is unfortunately full of them preying on those eager to make quick and easy profits.
Yeah, it's like the Wild West out there sometimes.
It can be. So it's crucial to do your due diligence research, any service thoroughly, before you hand over your hard-earned money.
What are some red flags we should be watching out for?
Lack of transparency is a big one. If a service is vague about their strategy, doesn't provide real performance data, or avoids answering your questions directly, that's a major warning sign. And always look for a free trial or a flexible subscription option. Reputable services will typically offer you a way to test their platform before you commit long-term.
That makes sense. Don't buy a car without taking it for a test drive, right?
Precisely. Now, another crucial point that often gets overlooked is transaction costs.
Yes, those pesky fees, commissions, spread slippage, they can really add up, especially for active traders.
They can, and they can significantly impact your profitability if you're not careful. So make sure you're factoring those costs into your calculations from the get-go.
So it's about looking at net profits, not just gross profits, right?
Exactly. You need to understand how those costs are affecting your bottom line and choose a broker with a fee structure that aligns with your trading style and volume.
That's a great point. It sounds like auto trading, while incredibly powerful, still requires a lot of thought, strategy, and careful planning.
It's a tool that can help you achieve your trading goals, but it needs to be used wisely and with a clear understanding of both the opportunities and the risks.
Well, this has been an incredibly insightful conversation. I feel like I've learned a ton today about approaching auto trading with a more informed and strategic mindset.
I'm glad to hear that. Hopefully our listeners feel the same way.
I'm sure they do. So to wrap things up, what are some final words of wisdom you'd like to leave our audience with?
Auto trading can be an incredible asset for traders of all levels. It requires ongoing monitoring management.
Excellent advice. So folks, as we conclude this episode on auto trading, remember to approach this powerful tool with a healthy dose of caution and a commitment to continuous learning.
As always, thanks for tuning in to Advanced AutoTrades.
And happy trading, everyone!